The Nasdaq Stock Exchange is currently closed. Plug Power Inc. (PLUG) last closed at a price of $3.48 on Friday, October 17, 2025, at 4 p.m. GMT-4, followed by an after-hours price of $3.44, representing a modest increase of 1.16% from the closing price. The consensus expectation for Plug Power often hinges on the day-to-day headlines, mostly focusing on whether the company's hydrogen production facilities are up and running or if a new analyst has just published a dramatically different price target. But the real deeper story that most investors are missing lies not in the daily news cycle, but in the recent, quiet institutional maneuvering that fundamentally changes the company's liquidity picture, a factor far more consequential than any single deal announcement. The recent warrant inducement agreement that netted the company approximately $370 million is the underappreciated development here. While it certainly provided an immediate and necessary cash injection, addressing the perpetual specter of capital constraints, this action also signals a level of institutional belief in a much higher future stock price. The investor in question was willing to exercise warrants at a $2 strike price and accept new warrants exercisable at a hefty $7.75, which is more than double the current stock price. This isn't just about cash today, it's a massive, long-term speculative bet by a sophisticated player on the stock's eventual ascent, an expectation that is much bolder than the street's current mean price target of around $2.36. This is the disconnect we need to explore: the immediate, acute need for cash contrasted against a major institutional investor's willingness to bet on a substantial future valuation. The common view of Plug Power is one of volatile speculation, a stock tossed around by clean energy sentiment and massive cash burn, constantly diluting shareholders to survive. For years, the market narrative has been defined by the company's ongoing struggle to achieve profitability, with consistent, sizable net losses and a rapidly dwindling cash balance. The recent performance has done little to calm these fears, even with a monumental rally in the last few months. The stock soared by over 112% in the last 3 months and over 73% in the past year, reflecting an almost vertical recovery from its 52-week low of 69 cents, a move fueled by operational progress and a short squeeze dynamic. But for every bullish headline about record production at the Georgia green hydrogen facility, there is the sobering reality of the second quarter 2025 financial results: a net loss of $227 million and negative free cash flow of $171.66 million. This cash burn rate, which totaled about $600 million over the trailing 12 months, is the reality that challenges the expectation of immediate profitability. The stock's recent movement has been a textbook example of high-momentum trading driven by news and technical factors rather than fundamental shifts in profitability. For instance, the stock surged by 37% in one day earlier in October, following news of a major hydrogen deal with Galp and an influential analyst raising their price target from $3 to $7. This reaction was amplified by short covering, given the short interest that hovers over 30% of the float. This short interest acts as a coiled spring, ready to snap the stock higher on any unexpected positive news. However, the subsequent price action, where the stock is treated choppily but largely sideways in the high 3 to low 4 range, suggests that while the excitement is real, the long-term holders are waiting for concrete proof of execution on the margin front. Volume has been incredibly high, with over 105 million shares traded on the most recent session, a clear indication that this is one of the most actively contested stocks on the market. The high technical rating by Nasdaq Dorsey Wright underscores the recent strength, yet the deeply negative profitability metrics, like a minus 292.84% profit margin, serve as a constant anchor, preventing the stock from stabilizing at higher valuations. Institutional activity reveals a complex picture. We are seeing major movements, both in and out. In the second quarter of 2025, while 196 institutional investors added shares and 150 decreased their positions, the sheer magnitude of some decreases is striking. Firms like Norge Bank and Heights Capital Management removed massive numbers of shares, indicating a retreat by some very large players. However, this was countered by others, such as Vanguard Group Inc., BlackRock Inc., and D.E. Shaw & Co. Inc., increasing their stakes, often by significant amounts. The fact that the total institutional shares held is around 430 million speaks to the divided professional opinion. One camp sees an expensive, loss-making operation, and the other sees a company strategically building an irreplicable asset base in an emerging sector, justifying a longer-term, growth-oriented perspective. Insider trading has shown a mixed signal, with recent director purchases, including one from the CEO and executive chairman, which provides a small but important vote of confidence that management believes the stock is undervalued, at least in the low 3 range. To understand why this stock is so volatile and contested, we need to look at what Plug Power does. They are not just a fuel cell provider. They are attempting to create a complete, vertically integrated green hydrogen ecosystem. This model includes 3 main business lines: GenDrive fuel cells for material handling, forklifts, a market where they have strong presence with major customers like Walmart and Amazon; GenSure stationary power solutions; and their GenFuel hydrogen supply and infrastructure business, which includes manufacturing electrolyzers and operating their own liquefaction and production facilities. The goal of building out the green hydrogen network, including major plants in Georgia and Louisiana, is to eventually eliminate the high cost of purchasing hydrogen from third parties, which has been the primary drag on their gross margins. The core expectation of the business model is that by achieving scale and producing hydrogen at a lower cost, potentially 1/3 of third-party purchases, as they've stated, they can turn their historically negative fuel margin positive. This transition is encapsulated in Project Quantum Leap, an internal initiative targeting over $200 million in annualized savings to accelerate the path to profitability. The company has made measurable progress on this, with gross margin in Q2 2025 improving significantly to -31% from -92% a year prior. But they're not out of the woods yet. The upcoming quarterly earnings report, expected around November 11, 2025, will be the next major tension between expectation and reality. The consensus EPS forecast is a loss of -$0.13 per share. The market will be looking past the revenue number, which is expected to show continued growth from increased electrolyzer sales, a segment that tripled in Q2 year-over-year, and will zero in on the gross margin. Management's expectation is to achieve gross margin breakeven on a run rate basis in the fourth quarter 2025. If the third quarter results show a continued significant trajectory toward that goal, the stock will likely see a positive reaction. Conversely, if gross margin improvement stalls, the short sellers will press their advantage, reigniting fears of cash depletion and further dilution. The stock's performance is, at this stage, less about the absolute number of fuel cells sold and more about the speed at which they can fix the underlying cost structure. Looking forward, the future outlook for Plug Power hinges on several clear catalysts and persistent risks. The main opportunity lies in the global energy transition, particularly the growing demand for hydrogen in hard-to-decarbonize industrial sectors, and increasingly for stationary power solutions like backup for data centers, which have an immense and constant power appetite. Government support, particularly the production and investment tax credits in the U.S., provides a substantial tailwind that helps close the cost gap between green hydrogen and conventional fuels. Execution on their large-scale projects, such as the 3-gigawatt deal in Australia and the commissioning of their own hydrogen production plants, will drive revenue and, more importantly, reduce the cost of hydrogen supply. The biggest risk, however, remains the company's liquidity and potential for future dilution. While the recent $370 million in funding bought them some time, their immense cash burn rate means that another dilutive financing event is an ongoing possibility until they can generate positive cash from operations, which the company doesn't expect until exiting 2027 for operating income. This is the reality check, a potential long wait for sustainable, self-funded growth. The market expects hydrogen to be a major part of the future clean energy grid, and Plug Power is positioned to capitalize on that narrative by building the infrastructure today. The harsh reality, however, is that building a global energy system is incredibly capital-intensive, and the company is constantly balancing aggressive expansion with fiscal solvency. The path to profitability is less of a straight line and more of a complex construction schedule, where delays in plant commissioning or cost overruns can have immediate negative consequences for the share price. The recent insider purchases and the large institutional warrant deal suggest that some sophisticated investors believe the company will survive this construction phase and realize its true value. But for the average investor, the trade remains a high-wire act between massive potential and the ever-present threat of capital destruction. We have discussed the intense daily trading volume, the recent short squeeze mechanics, and the underlying financial realities of this ambitious hydrogen ecosystem builder. Comment below how many shares of Plug Power, PLUG, you currently hold, or if you prefer to hold another stock in the hydrogen space, like Fuel Cell Energy or Bloom Energy. The story of Plug Power is a classic tension between a bold expectation of becoming a global energy leader and the financial reality of executing that vision one costly capital-raising quarter at a time. The true test of this stock will be whether the operational progress can finally outpace the cash burn,